We begin with the tax man or woman who may be picking more apples. Yes, the government is moving to catch OECD initiatives or match OECD initiatives to collect more tax and revenue source from multinationals like Google and Apple. This is an announcement that Winston Peters says was some time coming, too late. The government estimates somewhere in the region of $300 million a year is currently not being collected from multinationals who use legal means to move profits out of New Zealand and costs into New Zealand, thus reducing their tax bill here. The OECD estimates that globally the practice costs governments a total of, and I quote, between 100 and 240 billion US dollars annually in foregone taxes. Later on Checkpoint, we'll talk to the Minister, Judith Collins, on why this is happening now, how it will work and what it all means. But first of all, here's our political reporter, Craig McCulloch.
Unveiling the plans this morning in Queenstown, the Revenue Minister Judith Collins was talking tough on global dodging.
We mean business.
Among the proposals, a rule preventing corporate giants from shifting profits overseas if their New Zealand sales were driven by staff based in the country. Also on the agenda, more muscle for inland revenue.
IRD is being given more powers to investigate, more powers to make decisions, more powers to assess.
That means if a multinational is being uncooperative, IRD can determine how much tax it should pay unless the company can prove otherwise. A PwC tax expert, Jeff Nightingale, says the plan certainly has teeth. He says, in fact, they may be too sharp.
How do you define an uncooperative company? And that's where they have to be very careful, because once someone gets deemed uncooperative, then some quite strong powers come to play around the Commissioner's ability to demand information, make a tax assessment and collect the tax.
Judith Collins says Inland Revenue reckons about $300 million a year is being lost because of multinational tax avoidance in New Zealand. EY's Executive Director, David Snell, says the measures will probably force some companies to restructure their New Zealand operations and may add to the cost of doing business.
I don't think we would see a lot of businesses pulling out. We may see some investment at the margins not coming here that would have done. But if many countries adopt similar rules to ours, then the effect could be contained.
One idea that's conspicuously absent is what's called a diverted profits tax, a measure designed to penalise companies caught gaming the system. It's come into force in the UK and is expected to take effect in Australia from July. Labour's Michael Wood wants to keep the policy on the table.
One of the risks of the technical changes being proposed is they can get quite fiddly and detailed and may just open up the door to a lot of litigation. There's an argument to say diverted profit tax might just be a simpler approach. We should be exploring that properly.
But Ms Collins says the government wants to explore a different strategy first.
We're not ruling it out in the future. What we are saying is that we think that this is going to address most of the problems, and if this is successful, then we won't need to go down that track. If it's not, we're certainly not ruling out a diverted profits tax.
Labour, the Greens and New Zealand First have all broadly welcomed the plan, but have questioned why it's taken the government so long to crack down on multinational tax avoidance. The proposals now go out for consultation for about 6 weeks. From Parliament for Checkpoint, Craig McCulloch.